Good morning. Today, we're taking a closer look at one of the most influential companies in the global energy landscape. In the world of global energy, Lukoil stands as a titan, one of Russia's largest oil producers and a key player worldwide. Founded in 1991, Lukoil has grown from a regional oil company into a multinational corporation, with a presence on nearly every continent. Its operations stretch from the icy fields of Siberia to the warm waters of the Gulf of Mexico, making it a fully integrated powerhouse in the energy sector. Lukoil's reach extends across borders, connecting diverse markets and fueling economies around the globe. Lukoil's business covers the entire oil journey: exploration, extraction, refining, and distribution. The company invests heavily in advanced technology to maximize efficiency and minimize environmental impact. Its retail network is vast, with stations like Lukoil in Finland serving thousands of customers daily and providing a familiar brand across Europe. While its Russian operations are central, Lukoil's international assets are crucial, contributing about 500,000 barrels of oil daily. These assets help diversify the company's portfolio and reduce risks tied to any single region. These assets include stakes in top oil fields, state-of-the-art refineries, and partnerships with other major energy companies. Lukoil's retail businesses span across Europe and beyond, making it a familiar name for millions of drivers and businesses. Lukoil's global reach gives it influence in key energy discussions and a seat at the international table, where decisions affecting the world's energy future are made. The company's total output is about 2% of global oil consumption, a significant share that impacts prices, supply chains, and even geopolitics. Any major change in Lukoil's ownership or operations has global implications, sending ripples through financial markets and energy policies worldwide. Understanding this scale is key to grasping why the current situation matters to everyone, from industry insiders to everyday consumers at the pump. So, let's dive into what's happening with Lukoil right now, and why the developments surrounding this energy giant are such a big deal for the world. Why would Lukoil consider selling its prized international assets? The answer: sanctions. In October 2025, the US imposed strict sanctions on Russian energy firms, including Lukoil, aiming to pressure Moscow over Ukraine. These sanctions cut Lukoil off from the US financial system, making global business nearly impossible. For a company with a vast international portfolio, this isolation is crippling. Lukoil now faces a tough choice: hold on to assets that are losing value or sell them before sanctions erode their worth. The portfolio is valued at $22 billion, making this one of the largest energy sales in years. The US Treasury has allowed potential buyers to negotiate, signaling a push to transfer these assets out of Russian hands. This is a high-stakes geopolitical move, with oil assets as the main pieces on the chessboard. When $20 billion in oil assets hit the market, industry giants notice, especially Chevron. Chevron, a top US energy supermajor, is actively exploring a deal, but not for the entire Lukoil portfolio. Instead, Chevron is targeting assets where it already operates alongside Lukoil. This approach reduces risk and complexity. Chevron knows the projects, the politics, and the challenges. By acquiring Lukoil's stakes in joint projects, Chevron can increase its control and share of profits. It's a strategic move. Focus on assets that fit seamlessly into Chevron's existing operations. Chevron has stayed quiet publicly, but industry signals are clear. This is a rare chance for a US major to expand globally, all within the framework of US sanctions. The industry is watching closely as Chevron weighs its next move. The stakes couldn't be higher. Chevron isn't the only contender. When assets of this scale become available, a global bidding war erupts. US private equity giant Carlyle is also in the mix, signaling that this is as much a financial play as an oil industry one. Private equity firms like Carlyle may buy, streamline, and resell these assets for profit. Other international oil companies and state-owned firms from Europe, the Middle East, and Asia are likely circling as well. The US Treasury's clearance has opened the door for a truly global competition. Multiple bidders mean a higher sale price and more options for Lukoil. The race is on, and the outcome will reshape the global energy landscape. To understand Chevron's deep interest in Kazakhstan, you have to look at the sheer scale and strategic importance of its oil fields, Tengiz and Karachaganak. These are not just any oil fields. They are among the largest and most productive in the world, representing a cornerstone of Kazakhstan's energy sector and a vital source of global oil supply. Lukoil currently holds minority stakes in both fields, while Chevron is already a major partner and the primary operator. This partnership has been crucial in unlocking the vast reserves beneath Kazakhstan's steppes, and it's a relationship built on decades of collaboration and investment. At Tengiz, Chevron leads the way with a commanding 50% stake, giving it significant influence over operations and future development. Lukoil's 5% share, while smaller, still represents a valuable piece of this massive project. Acquiring Lukoil's share would be a seamless process for Chevron, allowing it to further consolidate its control and reap even greater rewards from Tengiz's prolific output. Over at Karachaganak, Lukoil's 13.5% stake is another highly attractive target. Chevron already partners here with global giants Eni and Shell, making the field a hub of international cooperation and advanced technology. Both Tengiz and Karachaganak feed into the Caspian Pipeline Consortium, a critical artery that moves more than 1.6 million barrels of oil each day from Kazakhstan to world markets, ensuring a steady flow of energy to Europe and beyond. These assets are not just important for Kazakhstan, they are essential for global energy security and form a central pillar of Chevron's long-term growth strategy. For Chevron, consolidating its position in Kazakhstan is a low-risk, high-reward move. It strengthens the company's dominance in the region and secures its access to some of the world's richest oil reserves. With billions already invested and a well-established operating environment, Chevron is uniquely positioned to maximize returns while minimizing uncertainty. For Chevron, these fields are truly the crown jewels of Lukoil's international portfolio, offering unmatched scale and profitability. In the end, the Kazakh assets stand out as the logical, most attractive targets, offering Chevron a rare opportunity to cement its leadership in one of the world's most important energy frontiers. Beyond Kazakhstan, Lukoil's sprawling portfolio stretches deep into Africa and the Middle East, regions that have become increasingly important in the global energy landscape. These assets are not just numbers on a balance sheet. They represent strategic footholds in some of the world's most resource-rich and geopolitically complex territories. In Nigeria, Lukoil holds a significant stake in OML 140, a major oil block operated by Chevron. This partnership makes for another relatively straightforward consolidation, as Chevron is already deeply embedded in the region's oil sector. The Nigerian government, eager to attract investment, has maintained a stable regulatory environment, making this asset particularly appealing to international buyers. In Iraq, Lukoil operates the massive West Korna 2 field, one of the largest oil fields in the world. However, the future of this asset is clouded by international sanctions and shifting political winds, which threaten to disrupt operations and complicate any potential sale. The Iraqi government is actively seeking a new buyer for Lukoil's stake, but has made it clear it won't purchase the stake itself. This decision opens the door for a range of new entrants, from regional players to global energy giants, all eager to gain a foothold in Iraq's lucrative oil sector. Lukoil's reach doesn't stop there. The company also owns refineries in Italy, Romania, and Bulgaria, providing critical infrastructure for processing crude oil into valuable products. Beyond Europe, Lukoil holds stakes in oil fields across Uzbekistan, Mexico, Ghana, and Egypt, further diversifying its global footprint and spreading its risk across multiple continents. This remarkable geographic diversity makes Lukoil's portfolio especially attractive to a wide range of potential buyers. From established oil majors to ambitious newcomers, many are drawn to the opportunity to acquire assets in both mature and emerging markets. The company's retail network is another major prize. Hundreds of petrol stations spread across Europe and the United States. These could be sold off separately to specialized operators, who value the steady cash flow and established customer base that retail fuel stations provide. For Chevron and similar companies, the focus is on upstream assets, oil fields, and production facilities. For others, the real value lies in the refineries and retail chains, which offer different strategic advantages and revenue streams. The sale process could be highly fragmented, with different buyers acquiring assets in different regions. This piecemeal approach allows for maximum value extraction, as each buyer can focus on the assets that best fit their strategy. Piece by piece, Lukoil's intricate global web is being untangled. Each asset, each region, represents a new chapter in the company's ongoing transformation. The divestment process is undeniably complex, involving careful negotiation and strategic planning. But for those who navigate it successfully, the rewards, both financial and strategic, are potentially enormous. What's driving Chevron's interest? It's about acquiring high-quality, long-life assets at a rare moment. The Kazakh fields are already developed, low-cost, and have decades of production ahead. Chevron is doubling down on what works. No need for risky new ventures. Acquiring Lukoil's stakes means instant growth, with infrastructure and teams already in place. The move aligns with U.S. foreign policy, transferring strategic assets from Russian to American hands. This could smooth regulatory approvals and boost Chevron's global standing. Chevron's strong balance sheet lets it buy from a forced seller, possibly at a discount. By focusing on overlapping assets, Chevron maximizes efficiency and control. It's a smart, strategic play, leveraging strengths to capitalize on a unique, politically driven opportunity. The timing couldn't be better for Chevron. A sale of this size, 500,000 barrels a day, will ripple through global energy markets. The top priority, a smooth transition that keeps oil flowing and avoids price spikes. Chevron's operational expertise reassures markets that production will continue reliably. The sale reduces uncertainty and risk, stabilizing the market after months of sanctions. For Russia, it's a major retreat from global energy influence. Lukoil's forced sale marks a shift in the balance of power, especially within OPEC+. The event highlights how deeply energy and geopolitics are intertwined. Access to Western finance remains a powerful lever in global energy. The world is watching how these strategic assets change hands under pressure. The story isn't over. Negotiations and strategic moves are just beginning. Watch for official bids from Chevron, Carlyle, and others, and for host country approvals. Will the portfolio be sold whole or in pieces? Chevron's focus suggests a piecemeal approach. The final price will reveal the true value and the impact of sanctions. Analysts will scrutinize every detail, from deal structure to market effects. The key: keep oil flowing without disruption. This is a pivotal chapter in the ongoing saga of energy, politics, and power. We'll be watching every step of the way.